Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show that helps you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me, we have Tim Kulhanek. He is the co-founder and a financial advisor at Stonebridge Wealth Systems, based right here in Nebraska, and Jeremy Gove, who is a partner and financial advisor. We've got a great show for you all today. The title of today's show is Tax Landmines: How to Diffuse the Lurking Threats to Your Retirement. Tim, Jeremy, always great to be with both of you. I'm excited to have this conversation with you today.
Yeah, us too. Good to be back.
Great.
Yeah,
well,
absolutely.
Good. Things are going well for both of you.
Yeah,
Staying
very
quite busy, right?
Yeah, excellent. Actually, we just got done with our birthday month. So June is the big month at our household. So both of our little girls were born in June, so we had a tiger party for Lenny, the 4-year-old, and we had the barnyard dance.
Oh, very fun.
Great book, by the way, for Hattie, awesome. The 2-year-old. So
very cool. Well, good. And Jeremy, I know that you are busy as well, and you guys have both been meeting with a lot of folks who've been calling in from the show. And seriously, taxes are on the top of a lot of people's minds, and that's why we want to dedicate an entire show to this important subject today.
Yeah. For sure.
Well, to kick us off, so there is an interesting stat. This is according to the Wharton School at the University of Pennsylvania. The U.S. government has a finite amount of time to take corrective action to restore fiscal responsibility to our federal budget before the threat of insolvency becomes what they call unavoidable. That's a real mouthful to say, right?
Yes.
But basically, the fall of 2023 and the spring of 2024 budget model additions suggest that once the debt to GDP ratio, and I know we're going to break this all down for you today, but once that ratio between the amount of U.S. government debt held by the public to the annual gross domestic product, or GDP, reaches 200%, any further policy efforts will be futile. That's what they're saying. So, Tim, why is this such an important topic for our viewers at home to understand and to hear about?
Yeah, I think when you get into kind of the details, and the Wharton School is probably the premier business school in the country for sure. And so sometimes the language gets a little wonky, but I can boil it down into 3 different reasons why this is really critical. First, it is our belief at Stonebridge that the biggest threat facing retirees today, oftentimes we think it's, what if there's, another global pandemic or healthcare costs. It is rising taxes. That is without a doubt. I don't think the second place item, whatever that might be, I don't think it's a close second. Number 2 is the reality is the majority of savings in this country, there's roughly $40 trillion. That's a lot of money, right? 40 with a T trillion dollars in retirement accounts in this country. The vast majority, I would estimate probably about 95%, is on that tax deferred side of the equation, which means taxes will be due at some point in time, and you don't have an option. We'll talk about that. We've talked about that on other shows with required minimum distributions. We'll hit on that in today's show as well. And number 3 is we actually have a window of opportunity. So this is the good news for our viewers at home. We actually have a window of opportunity right now to take advantage of some of the lowest tax rates we've seen in history in this country, which we're going to give you some illustrations of later in the show, to pay taxes at a rate we know versus postponing the tax payment to some point in the future where rates realistically could be stratospherically higher.
Right. Now, I think we need to point out here, obviously, people don't like to pay taxes, right? That's not a fun thing to think about. You are literally saying that taxes are one of the biggest threats to folks' retirement savings. And I could hear some folks watching probably thinking, well, gosh, that could be surprising given that we have market volatility, we have inflation, we have all these other aspects, we have an election year happening, right? There's a lot of other things. People are afraid of recessions, of potential healthcare costs going up. So why are you ranking tax increases at the top of the list of things that folks need to be concerned about?
Well, there's a couple reasons, Kristen. The first one is, I think the reason that people are frustrated with paying taxes is because we all believe, we could, poll the audience, and I think at least 9 out of 10 would say our government spends too much money. I don't think that'd be a shock to anybody in the audience. But so that's number one. The government is overspending. We're spending money that we don't have. We're sending money to other countries that we have to borrow to send to them.
Right.
So obviously that bill is going to have to be paid. And if you look at what does that bill look like right now? If you go to usdebtclock.org, you can actually see that thing spinning like a top.
Oh, it's terrifying.
It is terrifying. And so that's a great resource to look at and kind of keep in mind. I think there's even one of the senators actually wears it on his shirt to just kind of remind the other senators of what's going on. But so Tim mentioned that we have some slides that we'll show you. So if we could pull up the historical tax rates, if you look at this chart, there's a lot of different things that are going on in the chart, but we go back to 1913 through 2024. And the bottom line is you can see the different tax rates at different time frames during history. And some of them will make sense because if you look at like 1946, for example, there was things going on like World War II. So maybe it would make sense to have higher taxes. But if you look at the end of the chart, their tax rates are pretty low right now. And so there's another slide that we have that this is a really good kind of easy way to summarize this is from top tax earners. So our highest income earners, this is a chart for them. And you can see, this kind of spikes up and comes back down. And so it's easy when you see graphs like this or pictures like this, it kind of puts it more in perspective of why we say taxes are maybe on sale or lower right now.
Well, and I think it's important to point out because I think folks don't always realize that we are actually currently in the third lowest tax brackets that we've ever been in the history of our country. That chart really does put it into perspective. And I know that you've put together a chart, that same chart that viewers can actually receive if they call into the show. Is that right?
That's, absolutely correct. So we put a lot of white papers together to make sure that, it's not just, hey, you see it for 10 seconds on TV and, hey, I can't quite recall exactly what Tim and Jeremy were talking about. Folks can call into the show and request any of the charts that we're going to show you today. We've got those available for delivery in either PDF format or we can mail it out to you. But if we can pull up that chart one more time, the top tax rate chart, there it is. So I want to point something out here that I think is critical. Notice the highlighted areas in kind of that gold color. Now, a lot of people think, oh, that must be the years of the highest top bracket. But the reality is, if you look at the 2 years previous, 1944 and 45, that's the two highest years we've ever seen in history in this country, where the 94%, top 94%, right? But here's why those two aren't highlighted and the others are. What do you guys think, if you could guess, from 1946 through 1964, what did those years represent? Any guesses? Those are the years the baby boomers were born. So I have a question for our audience. You see that it was in the 90s for over 90% for over 20 years. Compare today's rates. The top rate today is 37%. So you could make $1 million and the top income tax rate you would pay is 37%. Call into the show and get that chart and compare today's top rate to the year you were born. And you make the decision. Do I want to pay taxes today where rates are much, much lower, or do I want to postpone taxes to a point in the future where they could be stratospherically higher, not just because Tim and Jeremy say so, not just because the Penn-Wharton budget model says that mathematically will have to happen, or any of the major economists are saying the same thing, but because there's a precedent for it. And in fact, the year you were born, the top tax rate was much higher. So here's how I'd like to kind of wrap this up in an easy to understand way. I mentioned my girls at the top of the show. I remember when I was growing up, I loved watching cartoons.
I did
Saturday morning cartoons.
Looney Tunes, it was all about that, right?
You got it. Like whether it was Bugs Bunny or Porky Pig or Mickey Mouse, cartoons are kind of my thing. And thankfully I grew up with a father, Jim Kulhanek, who also had an affinity for cartoons. And I remember an episode of The Roadrunner and Wile E. Coyote. And I'll summarize it this way. Basically, the Roadrunner always is outsmarting Wile E. Coyote, and he's got these dastardly plans. And in this episode, he was building a big bomb made out of Acme in a shed, a wooden shed that was also, of course, made out of Acme. And he's toiling away, making this explosive that he's going to finally get this Roadrunner. And unbeknownst to him, the Roadrunner pushes the shed onto a set of train tracks. Bad news, right? Well, he's working away on his plot, and all of a sudden he hears a locomotive, the train whistle blowing as it comes around a bend, bearing down on his shed, again filled with explosives. And he kind of has that wide-eyed look that the coyote gets. He looks out the window, sees the train coming, and he slowly pulls down the window shade and goes back to what he's doing. Now, what's the moral of the story? Well, we know how that story ends. The train hits the shed, it goes up in flames, it explodes. The crazy thing is the coyote never actually dies, right?
He's always okay.
He's worse for wear than the Roadrunner, but he never actually, meets his demise. The point is, the same thing is happening right now. We have a tax freight train bearing down on us, and we have two options. We can either bury our head in the sand, or in this case, pull down the window shade and pretend that everything's just going to be okay and it's not happening, or we can take action and we can put a plan into place. And that's what we'd like to offer all of our viewers out there today to do, is to take action, move forward with a plan, get a complimentary tax analysis by giving us a call. That number's on your screen right now. No cost, no obligation for this, but you're going to find out, am I in a position where I mathematically am going to have a problem with rising tax rates? And maybe you don't, but it's worth an hour of your time to find out for sure. It starts with a phone call to that number today.
Wonderful. Tim, Jeremy, thank you so much. I know we have a lot more to get into on today's show, but if you would like to be able to call to receive your complimentary written financial plan, and as part of that, as Tim said, you'll be able to receive that in-depth tax analysis from the team of Stonebridge Wealth Systems, all you need to do is pick up the phone and call. That number to call is there on the bottom of your screen, 866-256-7778. Or if you'd rather not talk to someone right now, but you do have your smartphone handy, don't worry, we've got you covered. You can simply pull out your phone, open up that camera app, point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Stonebridge Wealth Systems will reach out to connect with you to schedule your complimentary meeting that way as well. Don't go anywhere. We've got a lot more information to share with you regarding this important subject of tax landmines and your retirement right after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was gonna sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm gonna be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you wanna bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for him. And so, you know, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money, and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back, Nebraska. You're watching the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, here with both Tim Kulhanek and Jeremy Gove, and we are talking today all about tax landmines. Rising taxes, potentially rising tax rates, are one of the biggest problems that folks are facing in retirement, and we want to set you up for success so that you can successfully navigate those landmines, if you will, right? So we're talking today about this, and you mentioned in the first segment that the majority of Americans have the bulk of their wealth saved up in these tax deferred accounts. Things like 401ks, 403bs, traditional IRAs. I found this stat interesting. According to the Congressional Research Service, at the end of 2022, there was around $37.8 trillion in retirement assets in the United States. Why is such a high percentage of those in these tax deferred accounts?
That's a great question. And it kind of comes down to timing. Roth IRAs have only been around since 1997. Mm-hmm. So, if you think about retirement accounts, they've been around longer than that. So they just had a head start. So it's kind of makes sense, right?
Right.
One of the things that, when Roth IRAs came around, even when we started doing financial planning, I started in 2006, we didn't really talk about Roth IRAs that much because we weren't really thinking about taxes as much when we were talking to our clients about financial planning. Mm-hmm. And so as you think about this, the idea behind putting money into an IRA versus a Roth IRA, what happens? We get instant gratification because we're reducing our tax bill. As we talked about in the first segment, nobody wants to pay taxes. None of us like doing that. So that's kind of the idea behind it. It's just we're getting the benefit now, and our society is that type of society. As Americans, we want that instant gratification, For
sure. Well, and I was always taught, and I think a lot of people can relate to this, that we don't know what's going to happen in the future, but you should focus on lowering your tax liability now because potentially you're probably going to be in a lower tax bracket in retirement. I think that's something that a lot of people have heard. And so, I think it's hard to think about that in the future. We're so busy just thinking about the next 10 minutes or the next 10 days. It's hard to think 10, 20, 30 years down the road when it's so satisfying to reduce that tax liability now. Yeah,
that's a good point. And I think it comes down to, there's actually a scientific definition of this. It's called the pain-pleasure principle. That's a tongue twister as well. But the pain-pleasure principle, yes. The pain-pleasure principle, yeah. So the idea behind that is we're willing to spend more effort to avoid pain than to get a gain. And so, that's just the way we are naturally as human beings, I think.
Right. Well, the data shows that too. I mean, if you look at how much people spend to avoid paying taxes, I found this status from the National Tax Union Foundation. It says Americans spend roughly 6.5 billion hours collectively every year to try to mitigate their tax liability. So you think about that's not only individuals gathering documents, looking for deductions, their tax preparers, tax professionals, the CPAs, the enrolled agents, the tax attorneys. And it adds up to about $260 billion in what they call time drain. So in other words, time that people spent that they could have been earning a living just to file their taxes. That's how complex the tax code is and how much we really dislike paying taxes.
Exactly. We're trying to avoid that pain for sure, right?
Exactly.
Well, clearly, I mean, it's unbelievable when you put those numbers out there, just how much time, effort, money folks are spending trying to reduce their tax liability now. But why do you feel that folks should shift their focus rather than focusing so much on trying to lower their tax liability this year? Why is it so important to engage in this strategic tax planning process and look ahead to your retirement?
Well, if you think about retirement, it's not a one-year event, right? We don't retire for 1 year. And when we're doing our tax planning, in most cases, you're looking at 1 year. And a lot of times we're actually looking backwards. So we're looking at what did we spend or what did we make this past year? And so you're always looking backwards. And so what we propose is rather than matching, we want to match our plan up with how long you plan on being in retirement. So we don't, like I said, we're not going to be there for 1 year. We're going to be there for 20 plus years. So we want our planning to match up with that. I actually wrote down this quote from Will Rogers. It was kind of interesting. The difference between death and taxes is death doesn't get worse every time Congress meets. And I thought it was appropriate for what we're talking about here. So our whole goal in doing this and having this conversation is not because it's pleasant. Nobody likes talking about taxes. But we want to sound the alarm because everybody is going to pay. It's one of those situations where we're either going to pay now or we're going to pay later.
Yep, for sure. Well, and I know you guys stay really abreast and on top of what folks need to be understanding because the tax laws are always changing. That can be really challenging. And so recently, Tim, you got to attend Ed Slott's Elite IRA Advisors Group semi-annual meeting in Indianapolis. And for those of you that may not be familiar with the name Ed Slott, he has a reputation for being one of the foremost IRA experts in the country. So as we wrap up this segment, would you mind sharing some takeaways of what you learned from him as everyone is looking at this huge pile of money sitting in IRAs out there yet to be taxed? What do we do about it?
Yeah, and I wanted to mention Ed Slott just because I want to make sure that the folks at home know that, again, this is something that we're sounding the alarm on here locally and in our communities here across the state, but it's really something that is catching on across the country. So one of the quotes that Ed shared was that the IRA has been dramatically downgraded as a retirement planning tool with the passage of the Secure Act 1 and Secure Act 2. He has a new book coming out, just came out actually June 2024, called The Retirement Savings Time Bomb Ticks Louder. And I think that sums it up pretty well. And at the end of the day, I think what folks are looking for is kind of like an EOD tech, if you will, for more of a military type of analogy.
Explosive ordnance disposal.
You got it.
Right?
Nice.
Looking for someone who can help them diffuse this ticking tax time bomb. And really, that's what we're trying to do here at Stonebridge. That's why, I personally joined the Elite IRA Advisor Group with Ed Slott is because I want to make sure that I am staying abreast of all the changes. And I'm telling you, the changes that came down the pike with the passage of Secure Act 1.0 and 2.0, it is profound. The most substantial legislation as it pertains to your retirement that's been passed since the 2006 Pension Protection Act. And for those that aren't staying abreast of this, it is is filled with landmines, okay? So let us at Stonebridge and our team of elite advisors be your EOD tech when it comes to diffusing these tax landmines. We've got the experience and the skill set to do that. We'd like to get started with that complimentary tax review as you see on your screen. Give us a call today and we'll get started down that path.
Wonderful. And I just want to present Tim and Jeremy too for our viewers at home that what they are offering to you today is completely complimentary. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. It starts with getting this complimentary tax review. As part of that, you can look at your entire financial picture, really see what strategies you can be employing even now to help diffuse these landmines in your retirement. To claim yours, that number to call is there on the bottom of your screen, 866-256-7778. Or again, you're also welcome to scan that QR code and that will get you connected as well. More on the Retirement Compass right after this.
You know, if you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time,
I really should have done this years ago. But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with both Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Systems based right here in Nebraska. We've been talking today about tax landmines. The reality is that rising taxes, the potential of rising tax rates can be a huge threat to your security in retirement. That's why we wanted to dedicate an entire show to this important subject today. So we've talked a lot about the problems. We've set up this retirement ticking tax bomb, if you will, issue that a lot of folks are navigating. My question for you guys is, what hope can we provide to our viewers today? What are some of the solutions and the strategies that you and the team of Stonebridge Wealth Systems are able to employ for your clients to help them navigate these landmines successfully?
Yeah, the good news is there are lots of strategies that can be employed. And I think at the end of the day, it just comes down to having a plan. And that's why we developed the Retirement Compass the way we did is, so often when you go in and you meet with a new financial professional, the conversation usually goes one of two ways. It's either you've done everything wrong, it's terrible, change all of it, or it's, hey, I see you've got this IRA, and at XYZ company down the road last year, you did 7%. And that's pretty good. You've done great. You've got $800,000 in your IRA. Way to go. The thing of it is, had you been in our company, we could have done 8%. So let's roll that money over to our company. We'll get you that extra 1%. But the reality is, that's the thing that you have the least amount of control over. We don't have control over the stock market. There's plenty of quotes that we could pull out from the likes of Warren Buffett or Peter Lynch or any of the most well-known investors, the best investors of our lifetime, that say, look, this is a very, very challenging field to be in when it comes to generating consistent returns. And so what we do is we focus on the tax side. And there's a reason for all this. It's not just, hey, tax rates might go up. I do want to just hit on a couple things. I know Jeremy's got some examples of some of the things that we've been implementing, but I do want to just hit on a couple of the ideas that are being floated out there as to how the government could go about fixing the problem. And here's just a few. This is again from the Penn-Wharton budget model. And when we're talking about raising taxes, they talk about raising the top tax bracket from 37% to 45% beginning next year. Taxing capital gains and qualified dividends as income. I think that's the most significant one because a lot of folks don't realize that right now, if you're effectively in the 12% bracket, long-term capital gains, in other words, you buy a stock and you hold it for over a year, are taxed at 0. You don't pay taxes at all. That's outstanding.
Right.
But they're talking about moving that to income tax. So you pay at least 12%, which is scheduled to go up to 15%. So these are real proposals that are out there, doubling the Social Security wage base cap. So in other words, you pay more Social Security tax on your income. Some of them they think that will save a lot of money, but at the end of the day, they said, look, even if we do all these things, it still isn't going to get the job done, which means most likely we're going to see even more substantial increases. They either have to increase revenue or decrease expenses. How good at decreasing expenses are they?
Right.
Not very good.
Yeah. And that's the problem for sure. So on a practical level, Jeremy, what are you able to do for folks? So let's say someone calls in today, they come in, they get this complimentary tax analysis from you all, this tax review. Where do you go from there?
Well, it's a great question, Kristen. So when we sit down with people, we always start with figuring out where they're at. You got to know where you're at to know where you're going to go, right? So we got to know the starting point. And one of the things we look at is the tax map. Basically what that is it's where are you at in your tax bracket. As Tim mentioned, you might be in the 12% bracket, but you might have room because your income's low enough that you might not, before you jump into the 22% bracket, it might be $10,000 of income that you could use. And so one of the things we do, we talk about Roth conversions, or we might even pull money out of your IRA, pay tax now, and then put it in a taxable account. So the bottom line is there's a lot of different ways we can help you. The bottom line is we just got to figure out where you're at, and then we can develop a plan on how to mitigate those taxes and how to move forward.
But I think we're all in agreement after today's show. I know we've just kind of scratched the surface, but this is a problem. It's a problem that needs to be addressed, and folks need to understand the seriousness of it if they don't take action now.
Yeah,
they do. And what I'd like to do, we have just a couple minutes left. I'd like to pull up one more chart for our viewers to take a look at. And this is our tax bucket chart. And so from a practical standpoint, what we want to do is understand that in a rising tax rate environment, there is a mathematically perfect balance to have in each one of these buckets. If you look at that middle bucket, that's where about 95% of most folks' retirement dollars are located. And that is, you get a tax deduction, but it's going to be ordinary income when it comes out. So our goal is to shift any surplus to the right to that tax-free bucket. And again, that's things like Roth conversions, Roth 401ks, a Roth IRA, what's called a LIRP or life insurance retirement plan. There are strategies available for our viewers out there in order to ideally get to the 0% tax bracket, but to mitigate your overall lifetime tax liability by tens, if not hundreds of thousands of dollars. Again, it starts with a plan, and it starts with a phone call to that number today.
Wonderful. Tim, Jeremy, thank you so much for sharing your wealth of wisdom with all of us today. And thank you for joining us. We hope that you've learned something today and that you will take that action necessary to help you navigate those landmines. 866-256-7778. We'll see you next time here on the Retirement Compass.